Mortgage interest rates were as high as 16.63% in 1981, primarily due to high inflation and tight monetary policies implemented by the Fed to fight that inflation. As a result of astronomical interest rates, the housing market experienced a significant decline. Affordability was in the tank, became a major challenge for potential homebuyers and even for existing homeowners. The high costs of borrowing made it difficult for many to qualify for mortgages or to afford monthly payments, leading to a decrease in demand for housing. Maybe this sounds familiar because we've had interest rates go from 3 to 8% in a relatively short amount of time. It has created something of a loud club of market-watching bears who have been adamant that home prices will come down 30 or more percent in the coming years. Are rising mortgage interest rates always predictive of lower housing prices? Common sense thinking would tell us that when it costs more to borrow money, the pool of buyers will dwindle, and if that pool shrinks enough, there will soon be more sellers than there are buyers, with lower housing prices following shortly thereafter. Looking back at 1981, there were far fewer buyers in the market, and sellers were forced to reduce their prices to attract potential buyers. As a result, housing prices began to decline across the country. This decline was particularly evident in areas with already inflated housing markets, such as big cities, major metropolitan areas. Furthermore, the impact of high interest rates extended beyond affordability. Many homeowners found themselves unable to refinance their mortgages as the costs of doing so were simply too prohibitive. The lack of refinancing options added to the decrease in demand for housing and further contributed to the overall downward trend in prices. The consequences of high interest rates were not limited to residential real estate either. Commercial real estate suffered as businesses struggled to secure financing for projects or expansion. This created oversupply in the market, resulting in lower rental rates and decreased property values. In addition to the impact of high interest rates, other economic factors also contributed to the decline in housing prices. The overall sluggishness of the economy, combined with high unemployment rates and decreased consumer confidence, created an environment of uncertainty and caution among potential home buyers. Many individuals and families opted to delay their home purchase or just put their plans on hold altogether, further exacerbating the decline in demand. The decline in housing prices also had ripple effects throughout the economy. As home values decreased, homeowners saw that their equity was eroding, making it much more difficult to access home equity loans or lines of credit. This had a negative impact on consumer spending as household wealth and confidence declined. Moreover, the decline in housing prices had implications for financial institutions. With property values falling, the collateral backing up many mortgages diminished in value. This creates a bit of a significant challenge for banks and other lenders, leading to a tightening of credit availability and a decrease in the issuance of new mortgages. So it's no wonder that there are people out there who are bracing themselves for another round of tight monetary policy. If interest rates were to be maintained in the double digits for years at a time, there's no doubt there would be ripple effects throughout the economy based on less confidence that wealth can be stored or even generated by owning property. Here are 3 of the many reasons why mortgage rates may not predict housing prices. The first one significant factor influencing housing prices is the interplay between demand in the housing market and supply in the housing market. When demand exceeds supply, prices tend to rise, and vice versa. Mortgage rates, on the other hand, are influenced by factors like monetary policy of central banks, inflation, and economic indicators. The alignment or divergence of supply and demand dynamics with these factors may result in housing prices moving in a different direction than mortgage rates. Number 2, when mortgage rates can be influenced by economic indicators such as inflation, GDP growth, and the overall state of the economy, housing prices can be affected by a broader range of economic factors. Unemployment rates, consumer confidence, disposable income levels, and regional economic disparities of all contribute to the dynamics of housing prices. These factors may not necessarily align with the specific indicators driving mortgage rates, leading to divergence in their correlation. Number 3, speculation and investor activity within the housing market can heavily influence housing prices. Investor sentiment, expectations of future price appreciation, and market speculation can result in fluctuations in demand and subsequently impact housing prices. Mortgage rates, however, are primarily determined by objective economic factors and central bank policies. The actions of investors and speculators in the market can create a disparity between housing prices and mortgage rates. There are a host of reasons why mortgage rates aren't directly correlated with housing prices. The received wisdom that a lot of us follow is that higher interest rates must absolutely precede big dips in housing prices. Looking at Utah for the last year, we saw interest rates go from 3 to 8%, and housing prices were tenaciously sticky. Initially, prices came down 11% January of 2023, but through the summer, they went back into positive year-over-year territory. There may be some fluctuation in housing prices as rates find a new place where they'll settle in for a new normal. No one has a crystal ball, but for now, my money is on prices jumping up when we see rates come down 1 to 2 points in the near future, reflecting the tremendous demand that still exists despite higher interest rates. If you've been thinking about selling your home and you wonder what interest rates are going to do to your bottom line, reach out to me. I would love to connect with you, and I'm very grateful for all the people who've already done that. It's so fun to actually connect with the community of people who watch these videos, and I really am so grateful to be your local economist.